Hello, I'm Matt Scooby. Welcome to Market Call. Brian Madden is on the show today. He is Chief Investment Officer at First Avenue Investment Counsel. Going to be taking your questions on North American Equities. You can call us toll-free, 1-855-326-6266. You can also send us an email to marketcall@bnnbloomberg.ca. Brian, so certainly, again, a lot of activity, it feels like, too. We talk about this week on the markets, a couple of records, both here on the TSX, also south of the border. And we get into, you talked about in some of your notes as well, at least coming into this, the rapid and the rabid, it looks like, feels like the feast. Everybody wants stocks. Everybody wants to be in the market, it feels like at this point. Give us your sense of where things stand.
Yeah, I mean, the words that we're using to describe it is what you can really only characterize as rabidly enthusiastic demand for stocks. And that's manifest, of course, in the S&P 500 and the S&P TSX composite hitting successfully higher, fresh all-time highs earlier this week and continually really over the last few months. And really it's a sea change from what we saw earlier in the year when the war broke out. So what we have setting up here next week in particular is going to be an interesting test of investors' mettle, because I think sometimes we forget. We talk about oil and gold and cattle and coffee, and we talk about the forces of supply and demand, but we need to consider these in the stock market as well, because price at any instant in time is that exact level that calibrates the supply of stocks with the demand for it. And that's true whether you're talking about a single stock or an aggregate group of stocks like an index. So next week, we are going to have rabidly enthusiastic demand colliding head-on with unprecedented supply. And of course, what I'm referring to here is the SpaceX IPO, which is by leaps and bounds and by far and away the largest IPO ever in history. They're targeting a $75 billion equity raise. Not far behind them later this year in the mega IPO launch queue is OpenAI. And then leapfrogging them, rather surprisingly, earlier this week was Google, which is, remember, the world's second largest and most valuable company, a $4.5 trillion company, raising $80 billion. So we've never seen this kind of incremental supply coming into the market. So, we don't know how it's all going to play out. What we do know is, and history teaches us, that some of these blockbuster IPOs, yes, they garner a tremendous amount of attention. They don't always season that well and fare that well in their rookie season. There's all kinds of reasons for that. I actually wrote an op-ed in the National Post about this very topic about 9 years ago. So, what really remains to be seen is, this can go one of two ways. The IPOs that are coming down the pipe, SpaceX, OpenAI, could create a halo effect and sort of further fuel the frenzied enthusiasm investors have for thematically similar businesses, the likes of which have been driving most of the S&P 500 returns in recent years. Or, again, back to supply and demand, they could compete with some of these leading index heavyweights and siphon investor dollars away from them. So we're going to be watching the world, maybe the galaxy, it's SpaceX after all, is going to be watching with keen interest in the coming weeks and months. It's
going to be very interesting to see, I think, in particular next week and how things start at least to shape up. So we're going to get to this and going to take some calls here coming up after the break. We'll be back with Brian Madden of First Avenue Investment Counsel, taking your questions on North American Equities. Welcome back to Market Call. Brian Madden is our guest today. Let's get into some of our first questions. We are going to start with an email, too, that comes in from Mary. Mary's asking, Brian, may I please have your opinion on Wells Fargo, WFC? Brian, our thoughts on Wells Fargo?
You certainly may, Mary. Thank you for the question. So Wells Fargo is a big bank, what they call a globally systemically important bank, but a $250 billion company and one of four what we call in the U.S. money center banks. The business is sort of split between big emphasis on consumer banking. There's a commercial banking segment, a corporate and investment banking group, and then there's, of course, wealth and asset management. So not all that dissimilar from the other banks. Where it does stand out, and not in a good way, is it's got a return on equity that's kind of middle of the pack. Credit riskier than many of the banks. The non-performing loan ratio is a little bit higher than the average of those four money center banks. The efficiency ratio, which is the ratio of operating expenses to revenue, is very much a high side outlier. So there's probably some fat to trim there or structural disadvantages relative to some of the more lean and more efficient money center banks. The other thing is this bank was guilty of, let's call it, some bad behavior about a decade ago, and it was under a consent decree that limited the growth of their balance sheet in the United States. That was lifted about a year ago. So to some degree, it's kind of off to the races in terms of growing, competing for market share. And so it does have higher expected earnings growth than some of the other money center banks for that reason, because it was artificially throttled back for a few years. The chart's not that great, and so we don't own it. And in that space, Mary, we prefer JP Morgan, frankly.
Okay, yeah, certainly good to know, at least for there. Let's go to the phone lines, shall we, this afternoon. Anita in Markham, Ontario. Anita, go ahead.
Good afternoon. Thank you so much for taking my call, gentlemen. My question is on WSP Global. I bought some years back, and I did very well on those. So I got greedy, and about 6 months back, I thought I'll buy on the dip. And needless to say, it's not doing well at all. My question to you is whether I should cling on to you think it'll move up, or should I sell it and move on? I'll hang up and listen to you. Thank you so much.
Yeah, thanks, Anita. And you can see the chart there too, Brian, right? That the things Anita did well initially, and then it's fallen a bit off a cliff here in the last year or so.
Yeah, it has. And thank you for the question, Anita. And I should say it's a very timely one, because I had a meeting, a 30-minute meeting with the CFO, Alain Michaud of WSP Global just 2 days ago. So got a good update. I'll say we are shareholders. We own this stock in our Momentum portfolio. It's managed by my colleague, Ian Chong. We have owned it for a number of years, have done very well by it. However, yes, noting that it has pulled back pretty sharply since last summer. And this is part of a basket of companies that I'm sort of colloquially calling the AI witch hunt trade. So these are companies that are purportedly going to be rendered obsolete, competitive moats eroded by virtue of AI, alleviating any need for engineers. And of course, we think that is nonsense, as does the company. And so, some of the things that we talked about a few days ago were the fact that for big multi-billion-dollar or even smaller projects, clients and the developers take some comfort in knowing that a professional engineer has a legal liability and accountability. And of course, ChatGPT does not, needless to say. Moreover, a lot of the work of an engineering company is rooted in the physical world. So they're on site and doing things with their eyes and ears and hands and feet and stuff that a large language model cannot do. So if anything, AI is going to be an efficiency advantage for companies like this that deploy it well. It's a company that's very well positioned in a number of important verticals. So transportation and infrastructure is big for them, as is earth and environment. They got a lot bigger in power and energy in the last couple of years, acquiring power engineers and TRC. That puts them in the pole position, the number one spot in terms of market share for power and energy projects in the United States. That's all tied to the grid modernization, data center build out. Their backlog is big and growing there. That line of business is growing about 15%. In fact, they're capacity constrained. They can't hire engineers fast enough, frankly. So all this rolls up to a company that's been a tremendous long-term grower and compounder that's secularly advantaged by some of these nation-building projects. We think they're going to get some big defense contracts in the current quarter. And it's a very timely juncture to be, adding to it if you don't own it, but certainly sitting tight and holding on to your position with the shares trading at 15 times earnings, well below the 5-year average, 25 times multiple that it's traded at historically. So very good buy the dip opportunity, we think.
Okay. Let's go back to the phone lines. Rob is in Calgary here this afternoon with a question for Brian. Go ahead, Rob.
Hi, thanks for taking my call. I have a fairly large position in secure waste infrastructure, which is being taken over by GFL Environmental. And since the announcement in April, GFL shares have fallen by about 8%. So I'd like to hear Brian's opinion on GFL, and is this a company he would invest in, as I'll be forced to convert my secure shares into GFLs, or should I sell my secure shares before the deal closes? Thanks again, and have a good weekend.
Yeah, I appreciate it, Rob. You too. Thank you for the question. And talk about when we get into takeovers, can always be a little bit tricky, I know, at different points. But your thoughts here, Brian, on GFL?
Yeah, absolutely. Thank you for the question, Rob. So another company that we met with the CEO at a conference a couple of weeks ago, so got a good update on the business. We don't own GFL. We think it's sort of a riskier and lower quality waste company. There's a few big ones, notably Waste Connections, Waste Management, Public Services. Our preference and a name that we own in our dividend growers portfolio is Waste Management. It's got a higher credit rating and is more conservatively run, and it's a better mix of businesses. But broadly speaking, waste is clearly, a need and not a want. So it's non-discretionary, it's non-cyclical.
It's not going anywhere.
No, it's not going anywhere. However, Secure Energy, which I think is the name that you currently own, or Secure Waste, is more cyclical because it's sort of more narrowly focused both regionally in Alberta, and has got a particular industry focus on oil field services and waste removal, waste fluids, and that sort of specialty waste handling. It's a good business. This deal is being structured as a cash and stock transaction. So to the extent you can elect to take cash, we'd probably do that. But probably the safer play would be to sell your shares of Secure before the deal closes. We do think the deal will close, but GFL is not a company we'd want to be longer-term holders of, and would encourage you to look elsewhere in that industry, for instance, towards waste management.
Okay. That's, again, starting off for now. We're going to be back with Brian Madden of First Avenue Investment Counsel, taking your questions on North American Equities. We're back here on Market Call on this Friday. Brian Madden is with us. Let's get back into it, shall we? Another email. This comes into a viewer named Gene. Gene wants to know, what's your outlook on the Apotex IPO? So we were just talking about IPOs a little bit earlier, going to be very big next week too, in particular for SpaceX. But Apotex 2 in particular, looking to launch and plans to issue as many as 50 million shares, $20 to $24 a share. They're trying to raise over $1 billion, $1.2 billion. Give me your thoughts on that one initially.
Yeah, so this is not trading yet. The IPO is going to be coming fairly soon. Actually, I was just down at the TSX ringing the closing bell a few days ago, and they were very proud to have attracted this IPO. There is not much of a healthcare, publicly traded healthcare market in Canada. Of course, we have the publicly funded health system. The United States doesn't. So they've got a lot more wider and deeper opportunity set for IPOs. So we think this is going to attract a fair bit of attention. We've sort of looked at it a little bit, but for those who don't know, it's a long tenured private company. Of course, folks may know the founders had a tragic demise and what remains an unsolved mystery, a murder, in fact. The business transitioned from family to private equity, and now they're floating some shares on the Toronto Exchange shortly. It's a generic drug manufacturer. An exciting catalyst for them is GLP-1s have just been genericized in Canada, and so they've got, I believe it's the first sort of license to manufacture and sell these GLP-1s, which, needless to say, are selling like hotcakes. It's probably not a good analogy to use for a weight and obesity and diabetes drug, but in any event, this is a very well-positioned company in generic drug manufacturing, which is advantaged by scale. So it's one that we're going to be taking a close look at. We don't generally buy IPOs, but occasionally you want to make an exception. We talked earlier about SpaceX and these super hot blockbuster IPOs. Oftentimes they underwhelm. But then for every one of those, you have stories like Visa and Tim Hortons, which really find their niche. And we think Apotex is going to be probably more so in that camp. So it should meet with a warm reception when it does list here.
Okay, certainly going to be interesting to see that here in the very near future. Let's go back to the phone lines, shall we? Elizabeth is calling in from Edmonton with a question for Brian. Go ahead, Elizabeth.
Good morning. I'd like your guest's opinion on Shopify and what would be a good entry point for a longer-term hold. Thank you.
Thank you for the question, Elizabeth. Right here, right now is a good entry point for a long-term hold. This stock is the largest technology company in Canada. It is the fastest growing by most accounts. And it's also part of this AI witch hunt trade. The belief is that it's going to be rendered obsolete and the competitive moat eroded by virtue of agentic AI sort of disintermediating them. We don't think that's very likely at all. I think what a lot of people sort of don't understand in this sort of bear hunt for victims of AI is that writing code is not just about getting Claude or whatever to write the code. It's not a one and done kind of thing. You have to continually update it. There's agile development and debugging and protecting against cybersecurity vulnerabilities and that sort of thing. To say nothing of the complexity of creating a payments ecosystem, which is a big part of what Shopify does. That requires deep domain knowledge and relationships and a lot of security around it. So Shopify is just the leading, we used to call it e-commerce in a box. It is the great sort of enabler for originally small and medium-sized businesses who wanted to be e-commerce merchants. Increasingly, they're growing in large enterprise customers. And what they're doing really well is they continue to innovate. They're entering new markets, but even with their sort of old legacy markets and their existing merchants, they keep finding ways to add value for them and increasing their take rate or their percentage, attach rate on each dollar of gross merchandise value transacted on their platform, which is growing inexorably. And we think there's a secular growth story behind that has a long runway in front of it. So this is a good entry point. We've owned it for years, continue to hold it and add to it.
Okay. Let's go back to the phone lines too. Lawrence calling in from Vancouver, British Columbia. Go ahead, Lawrence.
Good morning, gentlemen. Mr. Madden, I'd be interested in having your opinion, if you please. Specifically, what effect you think the Elliott Group might have on the company going forward. Thank you very much for taking my call. Have a great weekend, gentlemen.
Yeah, Lawrence, I was on Lululemon, just cut out there just briefly, but thank you for the question. So the question's on Lululemon. We heard the second half of the question, I think, there. But go ahead, Brian.
Yeah, so, Lululemon, of course, is an iconic athleisure brand. I wouldn't necessarily call it fashion, but I guess athleisure is the correct word. I think every single woman I know has like 5 or 6 or more pairs of their yoga pants. They tried to create a market for menswear that didn't really find the niche that they were hoping for. And so there is an activist group that is sort of agitating for change, unsure that they're going to be successful. I think this is a brand that had the pole position in sort of inventing this athleisure category, but now there are other upstarts. Aloe would be one of them that seem to be sort of connecting more with the style sensibility. And so I think there's leadership change here, and there's going to be a need for some product innovation, renovation. We wouldn't step in front of this one betting on the activists being successful in turning it around. Obviously, the founder has been rather outspoken at various times over the last decade and being critical of management, and I think that continues to this day. But turning around a clothing line company can prove to be a long and difficult endeavor. So we would stay away from this one, frankly.
Okay. No, that's again a lot of turmoil. It feels like there in particular here recently. We are going to take another quick break. When we come back, we will have a look at Brian's past picks. That's coming up next on Market Call. Well, time now to have a look at Brian's past picks. These are from just a little less than a year ago, back on June 25th, 2025. Let's start in the energy sector with Tourmaline Oil in here. And a little bit, there's a green arrow on that bottom of that screen, Brian. But what are our thoughts and where do we stand too on Tourmaline?
Well, Matt, this is why total return is important and why we manage our portfolios for total return. Don't discount the importance of dividends. One of our equity mandates is a dividend grower's mandate. So here's your proof that it's not necessarily all about chasing the capital appreciation. But granted, all joking aside, this has been underwhelming. And that may be counterintuitive because a lot of other energy stocks have really taken off. So first of all, let's understand why. The company is called Tourmaline Oil, but it's not an oil producer. It's a natural gas producer. And it's, in fact, Canada's largest natural gas producer, producing about 13 or 14% of all the natural gas in Canada. And the stock has been kind of range bound for really the last 3+ years, like since the war in Ukraine broke out. We think it's undervalued. We think the Shell acquisition of ARC Resources was a watershed moment for the Canadian oil patch and natural gas in particular. So recall Shell is a partner in the LNG Canada export terminal, the largest foreign investment in Canadian history, $40 billion. We think it's quite likely that Shell acquiring ARC Resources was a tacit acknowledgement that the long reserve life, the geopolitical safety of the Western Canadian Sedimentary Basin has got strategic value in an energy insecure world that we're living in now post the Iran war. We think it's also probably a good tell that they and their partners are likely to green light the expansion of that LNG terminal phase 2. And of course, there's more of these LNG export terminals on the drawing board. And all this is very advantageous for Tourmaline because AECO, which is the Alberta hub for natural gas, is probably one of the lowest priced natural gas markets in the world. So getting more gas to Tidewater is going to unlock higher selling prices for all nat gas producers, Tourmaline, of course, being the largest. So we like this one, continue to own it, and think it's grossly undervalued. And so, if we talk about it again a year from now, we probably won't just be talking about the dividend yield, frankly.
Yeah, no, that's fair. The other one, we talked about U.S. banks a little bit earlier, too. Took a question on Wells Fargo's. And you mentioned this next past pick, JP Morgan, back at the same time, which you still very much like.
Yeah, 100%. So we own this in both our momentum and our dividend growers mandate. It's the biggest private sector bank in the world. We think, bar none, it is the best bank in the world. It operates in consumer and commercial lending. It's got obviously the big investment bank. It's got a wealth and asset management business. Banking is increasingly a technology and scale advantage game, and there's nobody bigger than this bank. Case in point, we talked about Wells Fargo earlier. Their efficiency ratio is 67%. And JP Morgan's is 52%. So that means operating expenses relative to revenue are 15 points higher at Wells Fargo than they are at JP Morgan. And Wells Fargo is not a small bank.
Significant.
Yeah. So you spread that over the $110 billion of revenue that JP Morgan earns. It's a massive advantage. It earns a 17% ROE, which is hundreds of basis points above its U.S. peers. So just the biggest and best global bank in the world. When's a good time to own it? Good time to buy it? Any day that ends in Y, frankly.
That's fair. The other one, talk about scaling too. Your last past pick feels interesting, Costco, and where we stand and how much bigger, how much more, where can they go? Again, minimal to returns here in the last year, but where do we stand on Costco now today, a year later?
Yeah, this one is barely in the green, but this is another one that's sort of buy and hold forever.
Yep.
This company is synonymous with club and warehouse retailing, and we like it for that reason. It's obviously the biggest in the world. It's, I think, the third largest retailer in the world, with Amazon and Walmart sort of being slightly ahead of it. But it's not just a retailer. It earns recurring revenues via the membership fees, and that's most of their profits, frankly. That comes with basically zero sort of cost of goods sold, so it's very, very high margin revenue. And then they earn about a 14% gross margin roughly on the merchandise. They have a narrow assortment. That advantages them. They're great at procurement and have a skill advantage in doing that, great at assortment. And they're also, not for me, because I really don't like shopping there, but many do.
I love Costco.
And most people would say that, so I'm just maybe not a very good consumer. But it's an experiential retailer, and that's a differentiator in a world where e-commerce is, sort of competing and eating the lunch of a lot of bricks and mortar retailers. I should also say it's an omni-channel retailer because increasingly Costco is seeing acceleration in their e-commerce and delivery channels. So very dynamic retailer. They continue to open new stores. So we continue to like and own this one in our portfolios.
Yeah, opening some new stores right across this country too. So certainly interesting. Okay, we're going to take another short break. We're going to be back with Brian Madden of First Avenue Investment Counsel, who is taking your questions on North American Equities. Welcome back to Market Call. Getting back to some more questions here for Brian Madden. Let's go back to the emails in the inbox. Mark writing in saying, hi, Brian, lumber stocks. I get they are in the basement and tariffs are not helping. However, would you invest with a 3 to 4 year timeline, or is it still too early? Certainly interesting. You know, we talk about some of the Kuzma news that we're getting today as a result that looks like we're not going to hit the July 1st deadline for Canada, US, Mexico to renew that. But your thoughts on tariffs in this industry in particular, if looking at that horizon of a few years?
Yeah, I mean, this is an interesting one. And, I would say this is a very easy question to answer. And the answer is no. So lumber companies are not good businesses. Period, full stop. And so why is that? Well, they're commodities, and that's okay. We invest in commodities, but generally, almost universally, not this one. At this time in particular, definitely not. There was a screaming moonshot of a run in the lumber commodity price in 2021. It got to something like $1,700 per whatever is the unit, 1,000 board feet traded on the Chicago market. And it had historically sort of oscillated between 200 and 500. So, that, of course, as we now know, is everybody building a big backyard patio and outdoor space because they couldn't congregate indoors. Well, that pulled a lot of demand forward. The price subsequently, as commodities are wont to do, crashed. And so it's been at more subdued levels. And now, of course, we've got tariffs, and tariffs aren't new. This is not a Trump thing. Tariffs have been plaguing the lumber industry my entire career, which is almost 30 years now. And they're not going away regardless of what happens with Kuzma. And it's just decimating the Canadian industry to the point that most of the remaining, and there's almost none left, lumber producers have diversified their business outside of British Columbia and Quebec and into southern yellow pine in the United States. But that's still not enough to offset some of these cyclical headwinds. So, if you want to play wood products, I would say really stay away from lumber. You can trade it, but I think your question framed it up as a 3 or 4 year investment timeline. That's way too long. These are trader stocks. These are not long-term investments ever. But if you wanted to make something that had sort of more investment merit, I would say, go downstream of the commodity lumber producers and look at someone who's actually, through manufacturing, adding value to raw commodity lumber. So names like Dolman Building Products come to mind, or Stella Jones, which makes utility poles. We've owned Stella Jones in the past. We don't currently. But yeah, we'd stay away from lumber stocks. The other thing I'll just call out here is the primary use for lumber is housing, and housing starts and housing demand is subdued and suppressed because mortgage rates are still high. So all kinds of reasons not to invest. So take that for what it is.
Yeah, laid a pretty good case there too. So hopefully that helps answer the question there from Mark. Let's go back to the phone lines now, shall we? Ray is calling in from Pickering, Ontario. Go ahead, Ray.
Oh, hi guys. Happy Friday. Yeah, Brian, I've been, calling into Market Call over, say, the last year, talking to various guests, and I was inquiring about Cisco Systems. And, my thesis was, how can Cisco Systems be ignored in this AI and data center build-out environment we're living in right now? And basically everyone said they wouldn't touch it. And but I still took a position in January, and again, I'm now up over 60% in my position as far as the stock price is concerned. And I've just never had anything jump like this in my career of stock picking. So I'm just wondering what you think I should be doing going forward. Should I ride this out further, or take a little bit off the table and continue to hold the stock? I'm just curious what you think at this point now.
Yeah, well timed by Ray, but I think to say the least with that pick in January. So go ahead.
Yeah, kudos and good on you, Ray, because this has not been sort of a market darling or an analyst favorite for a long time. And maybe I'm dating myself, but it was a market darling in the dot-com bubble. It was at one time, I think, one of the largest companies in the S&P 500. And then it had a lost decade, if not 2 lost decades, but it's caught a bid here. And we've seen this elsewhere in the market where, when the AI frenzy really kicked off in earnest, and I date that to basically the birth of ChatGPT around November of 2022, everybody wanted to get behind it. NVIDIA rallied first, so in the sort of AI chip space. And then the catch-up trade was in sort of the number 2 player, the laggard, and that was Broadcom. And so Broadcom then rallied. In switches and routers, we saw Aristanet, which we do own, and that would be our preferred name in this switch and router space relative to Cisco. It rallied first because these are co-products along with semiconductors for AI computing in data centers and elsewhere. And then again, going back to a bygone era, a fallen angel, former market darling, Celestica, which makes sort of white box, cheaper knockoff switches, rallied a few years after Aristanet. So I think you're seeing something similar here with kind of Cisco riding the coattails from the stronger players in the space. Whenever you have something like this happen, as the old adage goes, no one ever went broke by taking profits. So, the question is more than just, what do you think about Cisco? It's not our favorite, but it's probably, sort of catching the halo effect of all this massive capex in data center and AI compute. But your question gets to the heart of risk management and portfolio management. So, we trim, which is to say take partial profits on stocks that we continue to like and want to own when they get to be an undue or outsized weight in our equity portfolio. So we'd counsel you to do the same. And not knowing what the weight of this is in your portfolio, it's difficult to answer that question. But conceptually, that's what you want to do.
Yeah, some good advice. We do, especially depending on that position. Okay, we're going to take another break, but we're going to be back with Brian Madden of First Avenue Investment Counsel, taking your questions on North American Equities. Stay here. Welcome back to Market Call. We're going to go right back to the phone lines. Nizar in Scarborough, Ontario, has a question for Brian. Go ahead, Nizar.
Hi, gentlemen. Brian, may I have your thoughts on Canadian banks, please? They are trading at 52-week highs with high valuations. With Canada in a technical recession, prospect of economy slowing down, CUSMA uncertainty, can you please recommend an asset class or classes other than pipelines or infrastructure which can offer you a 5% yield, say, and some growth in this uncertain environment? Thanks for taking my call.
Thank you for the question, Nizar. That's a tall order that you're framing up. Because even the banks don't offer 5% yields anymore because, as you quite rightly noted, they have repriced higher to valuations that are outside and well above historical norms. And that's predicated on extremely robust earnings growth there. So I think to the extent they're sort of growing in weight in your portfolio, much as we counseled the earlier caller, no one ever went broke by taking profits. So trimming things that are getting to be an undue concentration in your portfolio is not a bad idea. You don't want to sell them, though, because these are companies, the basic growth algorithm, the math is take the dividend yield, add the aspirational growth rate, which they generally hit, and it's in the high single digits for most of them, add them together, and you've got a good line of sight to a double-digit total return over a cycle. And to alleviate fears about this technical recession, yes, it is a technical recession, but it's narrow. And it's concentrated in certain parts of the economy. It's not particularly troubling in the household space, but it's exports and things like that, and construction. And the other thing is the banks all have U.S. and global businesses, and the U.S., needless to say, is not in a recession. So we continue to own 3 of them. We consider them a core weight in our dividend growers portfolio, and counsel you to do the same.
Another caller, this Kareem from Ajax, Ontario, with a question. Go ahead, Kareem.
Hi, good afternoon, gentlemen. Thank you for taking my call. My question is on Agnico Eagle Mines. I'm noticing quite a drop today, especially in the metals across the board. Just wondering if your guest's opinion, if it might be a buy or a hold or a sell at this point. Thank you so much.
Been a tough day. A lot of red, I think, right across the board today, Brian. So our thoughts as we get into the mining sector.
Yeah, absolutely. Thank you for the question, Karim. We own Agnico Eagle in our dividend growers mandate. We've owned it for over 4 years, bought it shortly after the war broke out in the Ukraine. It's the biggest gold producer in Canada. We think it's the best. There's 12, I believe, operating mines, very low political risk, Canada, Mexico, Finland, Australia. We love the acquisitions. They've just done 3 of them that really consolidate the Lapland mining belt in Finland, paid a good price for what looks like a very prospective set of properties there that should make them a formidable producer in Finland for many decades to come. Pullback is viable, and of course, this is all predicated on the gold price falling off. And it has, it's cooling off, blowing off some steam after a meteoric run last year, but we don't think the bull run is over for gold. There's lots of reasons to expect it to continue, not least of which is central bank buying.
Yeah, okay, interesting. Another caller, Scott, is in Brooklyn, Ontario, with a question for Brian. Go ahead, Scott.
Thank you, gentlemen, for taking my call. Brian, I'd love to get your opinion on Go Easy and maybe what a good entry point may be. Thank you.
Thanks for the question, Scott. We wouldn't buy Go Easy right now. Haven't really given much consideration to what a good entry point would be because we consider it a very troubled business. It's a high-risk lender, subprime lender, operating under different banners. They've had a management change. They cut the dividend, I believe, to 0. The credit rating was downgraded, and they're booking big, unexpected provisions for credit losses. So there's risk and governance controls there. Generally, we don't want to invest in companies where there are risk and governance problems. There's too much that can go wrong. We like to buy things where something has to go wrong in order to lose money. This is a fixer-upper, a broken company that's trying to turn around. So really what has to happen here is something needs to go right in order to make money. Not a good risk reward in our assessment.
Okay, I want to thank all of our callers and everyone who emailed in with their questions for Brian today. We're going to take another break, but when we come back, we'll have a look at Brian's new top pick. Stay tuned for that. Well, join us Monday on Market Call. Mike Vinokur will be on the show. He's portfolio manager and senior wealth advisor at Propellis Wealth Partners, IA Private Wealth. We're taking your questions on North American large caps. And if you missed Market Call, you can check out our daily podcast. You can find it on the iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Well, time now for Brian's top picks now. We covered off past picks, at least at this point. We touched on GLP-1 drugs a little bit earlier too, Brian, in the show, and Eli Lilly is on the top of your top picks board for this time around. Tell us why.
Yeah, so this is the largest pharmaceutical company in the United States, and indeed, I believe, the world. Just recently joined the ranks of the $1 trillion market capitalization club, and as you can see, it's breaking out to fresh all-time highs here today in what we can only characterize as kind of a sloppy trading day. Obviously, it's best known for its leading GLP-1 drugs. So that's Zepbound and Mounjaro. One is indicated for diabetes, the other for general weight loss. But it's not really Johnny-come-lately. This is a company with a 150-year history of healthcare innovation. This is the company that was the first commercial marketer of insulin, of penicillin, the polio vaccine, Prozac, and Cialis, among numerous other distinctions. Obesity and diabetes do comprise about 55% of their revenues and growing like fast. But beyond that, they also market oncology, immunology, neuroscience, and other drugs. Nice thing about it is it's well insulated from the so-called patent cliffs, which is what happens when your patent expires and generics come in and compete at much lower prices. It's got one of the longest weighted average remaining patent protection lives across its portfolio of drugs. And moreover, 80% of their marketed drugs are what are called biologic drugs, as opposed to small molecule drugs. Biologics stand up to generic competition much better because it's more difficult for the generics to mimic and replicate them. So very well protected there and defensible. Prolific free cash flow, growing quickly. A lot of that is being funneled into an aggressive merger and acquisition frenzy this year. They've deployed about $18 billion across 13 biotech deals to sort of bolster the new drug pipeline. And that is on top of what's already a pretty robust internal research and development effort. And it's not an either or, but rather a both here. So the money is going into M&A, but also funding a dividend that's been growing at a 15% compound pace over the last 5 years. We think that will continue, and that's why one of the reasons why we added it to our dividend growers mandate last month. So it looks good here, we think, and promising future ahead for this company.
Yeah, solid dividend. Okay, let's get into streaming too, as our next one, which is interesting for me too. Netflix is on the board, at least for now. We talked about certainly not afraid to be aggressive in different points. Lost out in Warner Brothers in particular, I think most recently. But take us through why you like Netflix right now.
Yeah, so it's the clear global leader in high quality video content streaming. In a market there is competition, but nevertheless, Netflix has demonstrated some pricing power and best-in-class customer retention. We're expecting revenues to continue to grow at a healthy double-digit pace, and they should be able to garner some margin expansion such that earnings and free cash flow will grow much faster. We're expecting earnings to grow at a 22% compound pace over the next 3 years. And for context, the stock's trading at about 22 times earnings, so that's a pretty good sort of trade-off between value and growth. How are they growing revenue? It's aggressive investment into original content. So that's the traditional movies and shows, but also increasingly podcasts and live events, whether sports or stand-up comedy.
The sports has been a big one, it feels, recently, right?
Yeah, absolutely. Yeah. NFL games and things like that. The big Mike Tyson comeback fight.
Yeah, the fight. But they've been adding baseball too at different points. So it's been interesting.
Yeah, exactly. So that's a big catalyst. They're also capitalizing on digital advertising via their new ad-supported platform for customers who might be a bit more price sensitive. And then they're flexing pricing power across their global footprint. They just took a price increase somewhere in March, and so they'll likely continue to do that. So the pullback here, we think, is a very good buying opportunity. The market never really liked that Warner Brothers deal, and they were unsuccessful in acquiring that company. That got to be a hot bidding war. They got a nice consolation prize of a $2.8 billion break fee. That and almost all of their free cash flow is being funneled back into share repurchases. The company clearly sees the value in their shares, and so do we.
Okay. Last one, too, which I was surprised to see on the list, but I want you to explain why, but it's Constellation Software, too. Again, been a top performer for a long time. Why is this on your top pick list today? Yeah,
so we're taking the under on this whole AI witch hunt. Video killed the radio star, and AI killed the software company trade. So this stock is starting to perk up, but it's really been drawn down sharply in the last 12, 15 months. I think almost 50 or 60%, but you can see the chart starting to perk up there. So this is the biggest or the second biggest tech company in Canada behind Shopify. It's quiet and unassuming. It's not a household name the way Shopify is, but essentially we sometimes liken it to a narrowly focused private equity fund, specializing in acquiring vertical market software companies. Vertical market software, of course, is software that is not ubiquitously used across the whole economy like spreadsheets or PowerPoint, but rather might be used to run a vet clinic or a coffee shop or a golf course or that sort of thing. So in that sense, the product is mission critical. The revenues are sticky, albeit growing slowly organically. It's a very fragmented space, and so Constellation has been exceptional at deploying capital and buying up these little mom and pop or sometimes larger software companies. That slowed down in the last 2 years, but it's reaccelerated in the latest quarter. And they've also rolled out a new pathway to allocating capital, what they're calling permanently engaged minority shareholders, which allows them to take chunky and strategic long-term stakes in publicly traded software companies. So, anytime you get a dip in a company that's generated a 21,500% total return since the IPO in 2006, you buy it. And so that's what we're doing.
Yep, totally fair. I think understandable given where that is right now. So, okay, those are your top picks today. Brian, appreciate you joining us here on Market Call on this Friday. Have a great weekend.
You bet. Real pleasure, Matt.
Yeah, awesome. So again, thank you all as well for tuning in today on Market Call. I'm Matt Scooby. Stay tuned. We're going to have more coming up after this.